These 4 deadly mistakes will ruin your dividend portfolio. I have seen investors make them time and time again, and I have to admit I have also made some of them in the past. And today I will review them to you so you don't have to suffer like I and many others have. Hi, my name is Ognian, and on this channel I talk about investing and I help people achieve or at least get closer to financial freedom. There are 4 mistakes I have identified a lot of investors make when they start on their dividend investing journey. Unless you learn to avoid them, your investing strategy is doomed to fail and you're in for a lot of pain. So, without further delay, let's get started. Mistake number 1, focusing on high dividend yield only. This is probably the biggest trap for new dividend investors, and it is understandable. There they are, starting on the journey towards financial freedom, dreaming about that juicy passive income that will be coming daily to them while they're sitting on the beach, only to fail to realize it's too juicy. You see, the investing landscape is full of companies that have very attractive dividend yields, which are the perfect trap for newbie investor. Why? When they start their journey in dividend investing, people understandably want to maximize every dollar they have. They start calculating how much money they will be getting per year for the money they put in. And from that point of view, a 16% yield, of course, looks enticing. If they invest $10,000, they will get $1,600 per year. Now compare that with a modest 4% yield that will give them only $400. Focus on the $1,600, it's a no-brainer, right? Wrong. This is one of the biggest mistakes you could possibly make. It could lead to total devastation of your portfolio, your capital, and as extension, your dreams. It can even lead to your investments going to zero. I have seen this mistake made so many times that I really want to make sure my viewers and subscribers never have to go through it. As the old saying goes, you can learn either from other people's mistakes or from your own. You will learn either way. The question is how fast and at what price. So, to understand how to avoid this mistake, we have to establish a couple of things. First, the relationship between price and dividends. You see, the dividend yield is the expression of the dividend, which is paid in fixed dollar amount as a percentage of the current price of the company. If the company is paying $5 in dividends and the price is $100, then the dividend will be, waiting for you to guess, 5%. Alright, the price of the stock falls to $50 now because the company is not doing so well and is making less sales. However, they still have some cash left and they still pay $5 in dividends. Well then, 5 becomes 10% of 50. Now the dividend yield of the company is 10, not 5%. See what just happened there? A new investor sees this and they're like, hell yeah, 10% dividend, let's go. But what they fail to do is understand that the price has fallen because the company is generating less money than it used to. When it is generating less money than it used to, but it is still paying the $5 dividend, the following happens. Now we get into the second thing you need to know in order to avoid that mistake. Understanding the payout ratio. The payout ratio is what percentage of the profit of the company goes towards paying the dividend. Again, let's run with the previous example. If the company is paying these $5 in dividends and they used to make $10 in profit, this is a 50% payout ratio because 5 is 50% of 10. 50% is a sustainable ratio. However, let's say because their business is deteriorating now, they are only making $5.5 in profit, but they are still paying $5 in dividends. Now the payout ratio has jumped to 90%. That means that one bad quarter and the dividend can become unsustainable. And if the dividend is still $5 and the profits are 4, then the situation is obvious. Every single dividend investor needs to check that ratio first before they invest in any stock. How do you do it? Well, usually investors go to the income statement of the company and compare the profit, or in investors' term, earnings of it, to the dividend. However, that method can be inaccurate at times, and I prefer to use a different metric to determine the payout ratio, which I have made a whole video about, and you can check it on the channel or in the description, but not before you have finished this one. Remember, we are still only at mistake number 1. Okay, so to sum up, you never want to invest in companies solely because they have a high dividend. This has been the death of many newbie investors. These types of companies are also called yield traps, and I hope now you can understand why. There are countless examples of these companies out there, but I'll only give 2 now to illustrate what I mean. The first one is Orchid Island Capital, a mortgage REIT. As you can see, the yield is a mouth-watering 17.40%. Pretty good, right? Well, see what has happened with your investment for the past 5 years. You would have lost 73%. And this is the result for the last 10 years. 87% of your capital would have been lost. Let's see what has happened with their dividend. The history graph says everything you need to know. They have not only cut it once or twice, but repeatedly over the past decade. This is exactly the type of company you want to avoid, and it's a classic example of yield trap. The second one is Industrial Logistics Properties Trust. The yield on that one is only 0.9%, but it is because the fatal cut already happened in 2022. So I will use it as a great history lesson. If we check the yield of the company in the summer of 2022, it has reached the very appealing almost 10%. This might have been exactly the time when the company could have attracted a newbie investor that is seeking to maximize their dividend income. Well, bad for them. Very shortly after that, the company cut their dividend with almost 100% from 33 cents per share to 1 cent per share, and it has stayed like that since then. So, repeat with me here. Never invest by focusing on high dividends only. I'm waiting for you to repeat it. Okay, moving on to mistake number 2, investing in stocks with poor financial fundamentals. This one is closely tied to the previous mistake. Stocks are not just random symbols on the screen with price charts that go up and down. They are living, breathing businesses that have a lot of moving parts to them, and as an investor, you need to understand at least the major metrics and potential red flags. Never listen to random people on the internet who tell you to buy this or that stock because it is hot. And hey, if you are a first-time viewer of the channel, for you, I am a random person on the internet. I get it. But I'm trying to educate people and would never tell them to buy something now because its price will explode in the next 5 months or something like that. You need to understand why you are investing in a company. The better your understanding of a company's fundamentals, the less likely you are to make a mistake. This process is called fundamental analysis. In it, we analyze the company's financial position, its cash flow, its margins, the debt position, the return they have on the invested capital, etc., etc. It's too long of a topic to casually include within a video, so I would just give you one example. Let's say a company X looks attractive to you. Company X sells soap. They are in a very competitive business, and so you need to understand how is their business doing compared to other companies in the industry. In order to do that, you want to check how pressured their profit margins are. So either you compare them by hand or check a financial website and get a ready-made comparison. You see that the company only has a 7.34% profit margin, while the average for the other companies is 47%. This means that the company has very little room left to reinvest in the business, pay employees, and reward you as a shareholder after they have paid for the cost of the soap they produce. In that case, this will indicate to you that you might not want to invest in it. To sum up, it is always important to pick sound companies with good fundamentals so that your dividend investments can actually grow in time and provide you with that passive income you desire so much. Speaking of companies with good fundamentals, if you would like to see which are my top 4 stocks and ETFs for the current economic and geopolitical environment we are in, go to the link in the description. The report will be sent for free to your email address. It will always be up to date regardless of when you are watching this because I'm constantly updating it. Alright, mistake number 3. Selling your dividend stocks when the market is down. This is one of the worst ones, but also a very delicate balance to strike. You see, one of the reasons why I am such a fan of dividend investing is that as long as the fundamentals of the company are okay and the business is doing great, price doesn't matter. So there can be a huge downturn in the market and your stocks might go down a lot in price, but since you're still getting your dividends, you're doing fine. This requires, however, experience, mental stability, and conviction. Let's break it down. It requires experience because you need to understand that cycles like that have existed in the past and the current one is not the end of the world. It requires mental stability because you will be looking at your portfolio being 20% down and you will be sweating in front of your computer wondering how much more money can you lose. And it requires conviction because in order for you not to sell, you need to have a firm belief that what you are investing in is fundamentally sound and a good investment and will eventually bounce back after this turmoil. All of these things I just mentioned are very hard for a new investor, but they are necessary. What happens for a lot of people otherwise is that they will see their portfolio value decline, they will panic, and they will press the sell button. But unless you identify a company that is really struggling and their business performance is deteriorating, this is a huge mistake. A downtrending market is exactly the type of market your dividend stock portfolio should be built for. While everyone is struggling mentally and having to sell discounted shares to fund their lifestyle or wondering when their portfolio will be back in the green again, if you set up things right, you will be calmly collecting your cash from your dividends and riding out the storm. And then, eventually, when prices recover, you will have the shares of your stocks intact, while others will have suffered major losses because of selling their companies at a loss. If you're getting value out of this video, consider hitting the like button and subscribing to the channel by clicking the notification bell. That way, you will be directly notified when I create more videos like that in the future instead of relying on the algorithm to randomly show them to you. Thank you very much. Speaking of not selling during a down market, we come to mistake number 4. Not reinvesting your dividends if you still can. Unlike the previous 3 mistakes, this is not something that can be fatal for your portfolio, but you want to understand it because it can greatly limit the overall growth of your wealth in time, especially when prices of the stocks you own are down. First, let's explain the term. When you receive a dividend, you receive it as a cash payment in your account. Once you have that cash, you can choose to buy more shares of the same or another company with that cash. That way, instead of withdrawing your dividend to use it for yourself, you can get that money and purchase even more shares, which then gives you more dividends, with which you purchase more shares, creating an extremely powerful dividend snowball compounding effect. That snowball effect can rapidly increase the amount of wealth you create, especially during down markets, because then shares are cheap and you are buying more of them per unit of dividend. Of course, if you're at a point in your life where you need the dividends, by all means, get them. That's the beauty of dividend investing. You decide whether to improve your personal lifestyle, quit your job, go on a vacation, or increase the growth of your portfolio. In order for you to understand the difference it makes, let's give an example using a dividend compounding calculator. I will be putting basic data in the different fields. We don't need to focus on them as I am not analyzing a real company or a fund. I'm just trying to illustrate what happens with and without reinvesting. In the first example, we have $10,000 portfolio invested for 30 years without dividend reinvestment. As you can see in the red squares, after 30 years, the portfolio grew to $41,000 and you will be receiving $2,058 in dividends from it. Now, let's turn the reinvesting of the dividends on. As you can see, instead the previous $40,000, the initial $10,000 investment grew to the astonishing $150,000, and the dividends you will be receiving from your portfolio will be $7,175. That is a massive, over 3 times increase in the growth of both the value of your investment and the passive income you are getting just by turning on your dividend reinvestments. So this one is really a personal choice, but my advice is, if you still can afford to wait a little longer and you are not yet where you want to be financially, let those dividends get reinvested for a bit more before you start living with their help, and you will supercharge your portfolio. Dividend investing can be extremely rewarding in the long term, but only if you manage to avoid these 4 deadly mistakes. Of course, there are many more things that you need to be aware of when it comes to dividend investing than can be put into a short video like this. If you want help with that, I have a free dividend investing masterclass where I discuss in details what you need to know to start on your investing journey or improve your investing if you are already doing it. It will open your eyes for things you have probably not known, and best of all, it is completely free. You can check the next available date when I will be doing it and sign up for it in the link in the description. If you liked this video and you found it useful, you might want to check out the video that has appeared on your screen right now in order to continue with your investing education. Thank you for watching, and I will see you there as well as at the masterclass.